pal.
Hey there, I'm Pete Townsend, and this is Money Never Sleeps. We look inside the minds of entrepreneurs at the crossover of startups, enterprise, finance, technology, and life as we know it. This episode of Money Never Sleeps is sponsored by PAT Fintech, the training partner that demystifies fintech and digital finance for financial services professionals. Eoin Fitzgerald and I are back with another Money Talk segment this week. We talk through my first experience on Clubhouse, Z and Jack Dorsey partnering on Bitcoin for Africa and India, Fintech valuations and SPACs, Citi's fat finger, and a bit more on this week's episode of Money Never Sleeps. Hey Eoin, how you doing?
Yeah, pretty good. Busy week, but good busy. Not that crap busy. I don't like that. Bad jobs and bad work busy. This is a good week.
Yeah, it could go 24/7, couldn't it?
Oh, absolutely. Yeah, I was up till 1 o'clock last night, just breaking the back of an investment committee document. A really interesting project, which was nice, but just like you need, you know yourself, you need the time and space with a bit of quietness to actually write some of these things, to articulate the kind of story and what the company's doing. It's very early stage, so it needs a good kind of narrative around it. So I just needed the time and the hours to put into it last night to get that.
Yeah, it is all about the story.
Yeah.
Everything's got to have a beginning, middle, and end. Shout out to Ollie Judge, who got me into podcasting 2.5 years ago. And geez, 3.5 years ago now, nearly. And I did one with him recently. And he just reminded me, this is a story, right? It's got to have a beginning, middle, and end. And if you can stick to that discipline with everything you do, it's going to make your stuff more interesting, right?
Yeah, and I find, look, in terms of the stuff I'm doing, I get to pitch it to a committee. So the story bit, the narrative bit, I'm great at. But trying to put that in a 30-page document, I can do the 2-minute elevator pitch, but trying to write that story out in a 30-page document is more of a challenge.
Yeah, it is. It is. I was looking tonight at two things before we started recording at 9:09 p.m. here this fine evening, February 17th. And it was a startup deck that was a wonderful 12 pages long, maybe no smaller than 20-point font, only a few words on each page. It stuck with me. I could probably tell that story. And about 10 minutes later, I'm looking at a deck from a big financial institution describing their business in 52 slides in very small, right? Yeah. On the topic of brevity, let's get to it. We've got a few stories to cover tonight, a few things that we found over the last couple of days that we thought were interesting, follow-ups from other things we've done before that we've talked about, brand new topics, things that are happening out there. The first one that I wanted to look at was an article from Sifted that was just today that is titled, "Why Can't Europe Build a Clubhouse?" So Clubhouse has been making the rounds all over the media for the last month or so. It is a social media app, to put it very high level. To me, it kind of feels like a informal conference call / live podcast a bit. Okay, and we'll get a bit more into that. But the Sifted piece was basically saying, why can't this happen in Europe? Why does all this stuff need to happen in Silicon Valley? And the three key reasons that they said were, one, it's a fragmented market. And I talk about this a little bit as well. Or I hate it when I say I talk about this. I'm just going to say it. There is something about Europe, which is because there's 27 states in Europe, 27 countries, sovereign states. There are, I don't know how many languages, at least a few more than that, right? And it's really hard to connect the dots with B2C propositions when you have to translate into a whole bunch of different languages and with different cultures and different ways of doing things, right? So that was reason one. Reason two, European investors are not as familiar at building and scaling social media platforms, which is a fair point. I think TikTok is probably the only one that is scaled outside of the US. Third point, which I thought was a little bit funny, which was perhaps Europe is too snobbish, right? And that we couldn't be bothered with such frivolous things as helping people to connect.
Far too serious.
Yes. Looking at arts in the Louvre, So those were the three things that were pointed out. Have you put much thought into this?
Yeah, I think they're fair points. Like, we look at Europe, and I talk to my clients I'm working with, and we say, look, it's a common market, similar regulation. It should make it market entry easy in some ways, absolutely. But clearly in other ways, you're talking about 27 different states, different language requirements at the very least, different cultural requirements. So it is a challenge. And then to the Clubhouse example, they were able to raise, 10 million from Andreessen Horowitz without anything. like literally nothing to it bar the first kind of very early version of it. But they raised 10 million at 100 million valuation or something, I think were the numbers. So, and they've had the benefit then of Andreessen Horowitz heavily promoting them and pushing them. They were some of the earliest users on it. So they brought users to the platform. You don't get that kind of scale or that kind of reputation almost behind some of the European VCs that you would have with the likes of an Andreessen or a Sequoia.
Super
these guys
VCs.
haven't got super VCs. They're celebrities almost, in name. So you don't get that same kind of following behind it either. So I think there's that element to it, and I'd probably disregard the snobbish bit. I think the other two are valid enough reasons.
Yeah, I think so. So. What's their business model? How are they making money? Ads? We sell ads, Senator.
Do they have
probably something like that?
Are we? Yeah. Oh no, sorry. I believe it's going down my favorite new term, which is recurring revenue bundle. But it'll be a subscription model. I believe is subscribe for a certain amount of access. Because what's mad about it is similar to Twitter is that like you can join a Clubhouse with, I think they had Elon Musk and Kanye in a conversation recently. So at a certain point, that content is going to go behind an equivalent of a paywall, and you're going to have to pay for access to the more high profile stuff.
That makes
I would
sense.
guess.
That makes sense. I mean, Sifted themselves have already started doing that. Just this week, I started going into articles and saying, "Oh, this is paywall." So get people hooked, and then unleash the beast of money and make them pay.
Yeah.
First time Clubhouse user today, Rudy Falat from Voice of Fintech, who we had on way back episode 70 something. Shout out to Rudy. He invited me into his room today that he was doing, Future Tech Weekly. And I actually got an invite from Ahmed El Barki, who set up a business in Dublin here called We Code For You. So shout out to Ahmed. He's a good guy. And he was in the Naughty Fin Accelerator, not last year, the year before.
Okay, cool.
So I'm in, iPhone only. You got to set up your profile, start following a few people, pick out a few topics, whatever. All right. So Rudy kindly invited me into his. He had a couple of people on that were talking about a few different fintech topics. That's Rudy's thing, his Voice of Fintech. Yeah. And he invited me into the audience. Then he kind of said, Pete, listen, I know I didn't tell you in advance about what some of these questions may be, but do you want to answer a couple of questions? I said, yeah, sure, absolutely. So for the first half hour that I was on it, it was like listening to a live podcast, right? I'm in the room. There's probably 10, 12, 15 other people in the room. And there's Rudy and then two others that he had invited in as speakers. And then he said, Pete, do you want to come in and join? And he asked me a couple of questions on B2B versus B2C fintech, as well as we got into a little bit of ESG waters. I've been working on that recently with a couple of folks. So interesting. Could it have been recorded and perhaps published as a podcast? I think so. Right. Yeah. So did I have time to do that today? It was 5:00. It was an hour before dinner. I figured, what the hell? I might as well just do it. And I'm glad I did. So I'm going to be looking to do a bit more of that just because it was interesting thinking on your feet and hearing some topics that just in the normal course of your day, which is almost like I equated it to flipping through the channels 15, 20 years ago and finding Bull Durham on TV, right? You'd stop and you watch. You had no idea that you'd be watching Bull Durham. Now, except for this, this is, a movie you haven't seen before, a conversation you haven't participated in before. So I thought it was pretty interesting, and I'd look to keep using it, right? Yeah.
Okay, cool. Because, it sounds like a really strong on the community side, and it's a great way to kind of build communities around things.
Yeah.
But again, there's obviously limitations being iPhone only, so I wouldn't be able to use it myself.
I think that's just to get started. It's just to get started. But, just some of the things that came up that we were talking about was Elon Musk with Tesla, obviously, and their big investment in Bitcoin in the last couple of weeks. We'll talk about that in a bit. And one of the speakers was saying that does Bitcoin's electricity usage make it anti-ESG, right? Environmental, social, and governance, right? And that you're using so much electricity. The carbon footprint of Bitcoin is massive because of the electricity for mining. So does that then kick Tesla out of ESG portfolio, right? Which would be a pretty big deal because ESG metrics are pretty important to those portfolio managers that are managing ESG portfolios.
Yeah.
Right? I just thought that was that there was some logic to it, absolutely. But I was thinking, what about the electricity usage of AWS? Right? Are you going to kick Amazon out of ESG portfolios? Now, I don't know if Amazon is in ESG portfolios, but it's a much, much bigger topic. Just in a nutshell, ESG data that you measure to determine the ESG ratings of a company are basically all the non-financial data of a company. So all the financial data you generate ends up in the financial statements, all the non-financial data, well, that is now kind of falling into a bucket called ESG, right? Which is much bigger than what people originally had envisaged around measuring the environmental impact of a company, the social impact of a company, and how well it's governed, right? Which is a big thing. The NFTs and just digital collectibles came up. NFTs, non-fungible tokens, is a big topic. Been talking about that with a couple of folks more recently. I think we're going to get into that in future episodes. We got someone lined up to come talk to us about digital art.
Yeah, definitely.
Which we got going on. So we'll save that one for when we get into that conversation, because it's a bit lengthy to get into that. So if these thoughts are germinating in my mind because of that Clubhouse tonight, and I'm going to be able to pursue a few threads because of that, and probably provide some better guidance to the startups that I work with because those thoughts did germinate. Well, if that was Clubhouse, great. If that was just a random Wednesday, I'll go with it.
And I think actually in the absence of conferences and events and stuff, I'm thinking back to Money 2020 2 years ago, and the amount of like side conversations at events and panel conversations where were really interesting discussions going on. Like those things aren't happening now. There's a limited number of virtual events whereby, by the sounds of it, it was almost like being at a live event.
It was. It absolutely was. And the fact that it was audio only makes it much more manageable, right?
Yeah.
It's phone only. You're going to have better quality signal on your phone when you got Wi-Fi and you got mobile.
Even going around your house doing jobs, the same way I consume podcasts at the moment when I'm out for a walk or doing things while the kids are around. Like, it's ideal for that. So clearly there's something serious to it. I look forward to getting my own invite at some point.
Yeah, but you don't have an iPhone.
No, I don't have an iPhone at the moment.
I sent my last invite to Barry Brennan. Shout out to Barry. Yeah, I accidentally sent one to Dave Cunningham, but he was already in. So, Dave Cunningham from Citi?
I do,
good guy.
Yeah.
Shout out to Dave too. I know he's a listener. Yeah. Anywho, on to the next story. This one is a fun one. Z and Jack Dorsey's Bitcoin fund for Africa and India. So this was shared by Dan Runcie in his Trapital newsletter, which is
the business of hip hop.
The business of hip hop. It's brilliant.
I love that one.
I don't get to read it every week, but I picked up on it this week and saw that. So this is basically Z and Jack Dorsey getting together and saying, listen, we are starting up this Bitcoin trust and putting 500 Bitcoin into it between the two of them, which is currently worth 23.6 million. This was in TechCrunch. Wow. I think it was just on the 12th of February. So it's an endowment called the B Trust, with the B being the Bitcoin sign. And to quote them, the fund will be set up as a blind, irrevocable trust, Dorsey said, adding that the duo won't be giving away any direction to the team. They are looking to hire 3 board members, so guess who applied? Yours truly, on the basis of a chair role and independent directorship that I have with a leading cryptocurrency service provider, as well as my board role with Pipit. And Pipit are
doing great things in Africa.
Pipit are enabling migrants to support their families back home cheaper and safer. Shout out to Ollie Walsh, who's been on this podcast with us in the past. He's founder and CEO. I'm on his board, and they are really enabling those that have left home from the African continent and from other continents around the world to go live in economies where there is more job opportunity. They make money and send it back home. Pipit allows you to do that through cash, right? Where you can just send the cash that you make back and pay your mother's healthcare bill, get it to a bank account back home, wherever it needs to go, and do that digitally. All right. So on the basis of those two things, I said, hey, I'm supremely qualified to be on the board of the Bitcoin Trust. So we'll see what comes through on that. It was like a 3-line job application on a Google form, right? So I sent that.
Yeah, well, there you go.
But I mean, just again, that merging of hip hop and business, right?
Yeah.
With Jay-Z.
Yeah. And Dorsey's big on the philanthropy side. He's very focused on Africa. Like you said, I'm a big fan of both of them. So I only hope it works out.
Yeah.
Well.
I mean, there is a talk right now that India is looking again to ban Bitcoin, perhaps, but we'll see what comes of that. But I think the idea is that with Bitcoin, and particularly just seeing Elon Musk and Tesla and what they're doing recently, and that looking at PayPal, the idea is that if you build up an inventory of Bitcoin, right, it becomes more of an asset that you would use to do things with, rather than just holding it as a treasury asset, right, or looking at it as an investment. And when you have an inventory of it, you're probably more willing to, like I said, pay for things with it, but also accept it as a form of payment. And that's what Tesla are looking to do with it. And the more that it becomes part of the day-to-day business of different economies, which is still, there's a long arc to that journey. So
Yeah.
We'll see what comes of that. But I will let everyone know if I get the job.
Absolutely. Cool. You can live stream your interview.
I will.
With Jay-Z.
That'll be a lot of fun. On Clubhouse, maybe. Yeah.
Yeah.
Yeah. Or we could do it right here on Riverside. Absolutely.
Absolutely.
So the next story I want to take a look at here, Fintech valuation multiples with SPACs. This was in the Long Take newsletter, or the Fintech Blueprint from Lex Sullivan on the 15th of February, just this past Monday, basically saying that banks trade at 10 to 20 times earnings, right? Earnings being the key word there. Fintechs and private market deals go forward at 20 to 100 times revenues, right? Because it's software, right? That was what was quoted in the newsletter, which there's obviously some rationale to, and I never had thought about it too much when people said to me, why are we valuing private market deals in fintech at, on the multiples of revenue rather than multiples of earnings? And I said, well, a lot of them have no earnings. So you got to do them on a multiple of something, right? But I hadn't thought about the fact that when you're selling software and the cost has already gone into developing that software, there's a lot of profit in every deal that you do. So revenue is probably a more consistent number to measure rather than earnings. So what that means is that if banks are trading at 10 to 20 times earnings, but when fintechs are in private market deals at 20 to 100 times revenue, if you just assume a 10% fintech margin, that's 15x average for banks trading. That's 500x for a fintech that is entering the public markets through a SPAC, or a special purpose acquisition corporation. The way these things work is that an investor forms a company, raises a bunch of money, 300 million to $1 billion seems to be, or even higher than $1 billion seems to be the figure, and then goes public with it and buys a late market deal company. And that's the way that company goes public. And it's looking like, I saw this other piece today, I forget who wrote it, that said something to the effect of, for the year 2021, it looks like the SPAC deals will already surpass the basic IPO deals, somewhere in the region of 50 billion to 25 billion, which is a pretty big deal. Some of the names are talking about Payoneer, payments provider in the US, SoFi, Apex Clearing, who are some of the plumbing behind Robinhood, and Moneyline being another one. So who is the SPAC champion of the world? Yes.
Shamat. Okay.
But yeah, he's the big SPAC king out there. Yeah. Is this going to change things remarkably going forward, do you think?
No, I think, like you said, it's another option. No, I think there just seems to be plenty of money out there. The multiples are interesting. And I suppose is it a way to take some of these companies public that may not have necessarily wanted to go public, or they may not have had a path to that yet? Is this the way to do it, that, they're doing it in a favorable way for themselves? What company is going to turn down effectively an approach from the likes of a Shamat with the funding to bring it public, as opposed to maybe going a more traditional route? Yeah,
I'm with you. Now I'm thinking about it. So the IPO method itself, I heard someone describe it, is just a massive wealth transfer is all it is, right? You've got a bunch of people buying in at the IPO price in the market, and then it skyrockets. Not all of them do, but a lot of them do. And people are buying along the way and buying and then selling along the way. So all that is, say you open up on the market at 25 and close on day one at 100, you've had $75 per share in value transfer between people just buying and selling.
Yeah.
Right? With a direct listing, you are bringing shares to market and just saying, listen, it's just going to start trading, right? And, there's no big pre-order book, no big investment bank involved, none of that. It's just, we're going to open these shares up for trading so that we can use the capital markets with our equity in order to fund the business going forward. Wonderful. Great. With the SPAC, you kind of get a little bit of both, right? You get that pre-market investment before things go public.
Yeah.
And, I guess the investors who take that risk on the way in when the SPAC is first founded are the ones that enjoy the most upside, right? So you get a little bit of that without the old school investment banking model that is used to bring an IPO to market and do all the roadshows and that kind of stuff beforehand.
You're probably getting better value then from that investor group than going down the roadshow route with a JP Morgan or whoever, in terms of what they're bringing to your business other than the road. The valuation piece is interesting, I think, because like you look at a typical bank and where's the real upside with a traditional bank? But then you look at some of the fintechs, and we talked about who Payoneer there. With any of those, there's potential upside as they kind of diversify or build out functionality because they're software companies.
There is. And it's the ability to adapt, the ability to pivot. And I'm not going to get into the NFT example today. It had something to do with baseball cards. I will, actually, because it's very quick. And it was basically, once you get that old school cardboard baseball card into the digital realm where it is unique, it is scarce, and they're obviously limited issue, and you have individuals, consumers, collectors, whoever, that appreciate that way of having a collectible and owning a collectible, it's limitless what you can do with that, because you are now in the digital world, and it's not just the static piece of cardboard. What you can link to that is just unlimited. And I think that that's a lot of the thinking going on around non-fungible tokens right now. With fintech, right? When you take that old school banking model, right, based upon paper and old pipes and plumbing and things moving around and, inboxes and outboxes still on people's desks and fax machines and printing things out in different color paper so people don't screw up, right? And know that the pink is for a buy and the yellow is for a sell. Right? When you move things out of that environment, you're creating so many more monetization opportunities for what you're doing, the data you're generating. It's, I'm not saying it's limitless, like what's his name, Bradley Cooper in the movie, but more upside. Thank you. Thank you. I think that's the best way to put it. But the valuations are scary, but I think we talked about this in the last 6 months, that I think all bets are off with those old economic textbooks on how value is perceived in a company, which again is just, scary to this brain that heard this story back in 1998 with, the old economy stocks and new economy stocks that turned out to be the .com bubble stocks, right? But, anyway, we know the story there and how it all unfolded. This episode of Money Never Sleeps is sponsored by PAT Fintech, demystifying fintech and digital finance for financial services professionals. PAT Fintech enable financial services professionals to transform their capabilities into the digital age, with dedicated virtual training programs geared towards those that can develop, deliver, and monitor optimally customized user experiences balanced by appropriate governance, control, and oversight. To learn more about PAT Fintech, go to moneyneversleeps.ie/PAT Fintech. A couple of others that we thought were interesting. Citi lost their legal battle over $500 million in a funds transfer gaffe, where I think they redeemed by accident a Revolut bond when it wasn't meant to be paid back. It was just the interest that should have been paid on it. So there was, in a court ruling, basically the court said, sorry, you can't have the money back.
So it was $900 million they sent, and they got 400 back, or they managed to hold 400 or not have that sent fully. But I saw, because the New York Times had information on it today, and they were saying that it was down to some contractor ticking the wrong box on some digital kind of process.
No, manual process, not digital process, right? Which implies that the person who did it was a clerk. I'm sure their job title is not clerk.
But they have a 6 eyes kind of process, and the judge is like, you have a process. I wouldn't say, it's ridiculous, but at the same time, it's more ridiculous because I had an incident not too dissimilar in my old banking days, which was maybe 10 years ago now, which related to funds being sent before they were received by the bank I worked in. And it was 20 million. So we were left in a 20 million position, negative 20 million position overnight on our balance sheet. And everyone kicked up murder the next day. But we shouldn't have been able to release the funds. And it was down to, I get a phone call from the kind of payments team. Am I happy to process this payment? And I just say, yep, because I was expecting it to go out. I was expecting the funds in. And that was it. And it's still happening to this day.
It is. No, I mean, product line decisions are made the same way. I remember it back in my banking days, looking at a new product called bond clearing. I won't get into what that is. But for the level of bond trades that were being settled, that you could basically lose your entire revenue for 1 year from having that product live within the bank by a Friday screw up, right? Because by the time Monday rolls around, the interest charge on that to get that settled properly in the market, you've just wiped out everything because of the size and scale that you're dealing with, because these markets all settle manually. It's absolutely ridiculous. And this has come up a couple of times over the last couple of weeks, looking at how inefficient the public markets are, not in terms of trading and price discovery and all those types of things, but it's after the trade. It's the post-trade that so many of these things that exist that people don't know about, things that happen behind Robinhood during the GameStop pandemonium, that we don't have these same problems in the crypto markets. Now, the crypto markets are young, obviously, right? but they trade 24/7. The trade is the settlement. Everything is pre-funded, right? And that is good discipline. Now, all of the momentum is going towards this type of environment with the digital asset businesses that I'm working with, like the guys like Fund Admin Chain, guys at QPQ. They're working on all these types of things in order to make these public markets far more efficient, far more digital, and far more like crypto, dare I say. Now, Greg Chu would roll over in his, well, he's not in bed right now, and he's definitely not in a grave yet, but Greg Chu is the founder of QPQ. For me to equate him to the efficiency of what he calls, what does he call it? Betcoin, not Bitcoin. He's going to reach out and strangle me across Dublin.
Yeah. But I think it ties into what we just talked about around the valuations, because like a lot of those examples we gave, they're plumbing, they're infrastructure, and that's it. Like so much value is still, and there's so much value to still be brought and innovation to still be brought in financial services in that infrastructure and plumbing piece that people don't even realize kind of from the outside. Everything is focused on the direct to consumer, the sexy stuff, but actually like infrastructure and the plumbing behind a lot of these things still is so far from being digitized.
Absolutely. It's going to take a while, but there are enough pioneers out there, enough now, Series E, going to direct listing, going to IPO, whatever, being brought to market in a SPAC. Yeah. These are mature companies that are growing up across this blurring line between digital assets and fintech, which is pretty cool because that's my life, besides my family, right? So, anywho, one other thing, just on the topic of crypto, a crazy week it's been. Bitcoin surpassed 50,000 yesterday. When I was on the phone with, he wouldn't like me to mention that because he said, Pete, if you ever say anything about this conversation that you and I had, I'm going to deny everything in court. So I won't mention who I was talking to as Bitcoin crossed over 50,000, but he knows who he is. Well, I'll see if I can get him to listen to this one. He might like it.
Yeah.
But Goldman Sachs, BNY Mellon, Deutsche Bank, Visa, MasterCard, Morgan Stanley, Twitter, Uber, all these companies talking about either providing crypto services or investing through their treasuries into crypto. I thought there's this guy, Jeff Dorman at Arca. They have their newsletter called That's Our Two Satoshis. And what he said was Bitcoin gets all the headlines while other digital assets often make investors and companies all of the money. We love Bitcoin, but again, it's a very simple thesis with a limited future evolution, right? It's your gateway into crypto. Now it is the biggest, most valuable, biggest stalwart that is the most mature at this stage. So it was a massively crazy week, but I don't expect things to really slow down at this point. I'm not looking forward to catching my breath.
100K for year end. Isn't that what Pompliano was quoting this week on Twitter? I saw him, he was on one of MSNBC or something being interviewed the other day, but he was saying 100 grand by the end of the year.
Yeah. I missed this. I missed his announcement back in, I think it was October, November, that, he's getting a rolling fund up and going.
I saw that.
Awesome to see that. So those were the key stories for tonight, Mr. Fitzgerald.
Yeah, plenty. And then I had one small one, and it was more just amusing when I saw the headline in the Irish Independent this week about customers are angry as Revolut ups its fees for ATM withdrawals and deposits and stuff. I was like, oh, shocking news story. Bank, raises fees to make money.
Yeah, free bank.
Free bank, exactly. Free bank raises fees. Like, okay.
Well, like
nobody saw that
like
coming.
We said, get everybody hooked and then just unleash the beast. And get everyone paying. Yeah. That's one we talked about this before. WhatsApp never did. I remember way back in the day seeing that we're going to start charging you 99 cents a month for this, and they never did.
Yeah, I remember that,
Facebook kind of squashed that. But that one is good. I missed that, but I can kind of rely on you to keep tabs on all things Revolut.
Oh yeah, absolutely.
I did actually get to use Revolut over the weekend, where I was buying a bike helmet, and the shop said, we only do cash or Revolut. And I'm like, really?
Okay.
And they're like, yep, only cash or Revolut. We used to do only cash, but so many people were coming through saying, hey, you guys got to take Revolut. And so the woman at the bike shop, I was kind of embarrassed. She had to walk me through how I set up pay people near you.
Oh, yeah. I've done that, yeah. It's a little bit complicated because if you only do it every so often, you forget the next time. But because I've had to do that a few times. That's bizarre. Like that's bizarre to say only cash or Revolut.
Yeah, exactly. One or the other. And when she's walking me through that and saying, no, not there. No, that button. I'm like, don't you know I'm in fintech? Obviously not expert enough. All right. Well, I think we're going to call it a night there. What do you think?
Yeah. Sounds
and
good.
we got another bunch of interviews coming up over the next few weeks. I think we're scheduled out for the next 2 months, at least at this stage. So
I know.
That does it for this week, folks, and you can learn more about the stories we covered in the show notes on our website, moneyneversleeps.ie. So check us out online and subscribe to our weekly Money Never Sleeps newsletter as well. Also, thanks to Conan Brophy from Create Sound for mixing and editing this episode. Conan is an excellent media man to get in touch with when you're thinking about launching your own podcast. As for me, I'm the founding partner at Norio Ventures, and I'm an early-stage startup advisor and an investor focused on fintech and digital assets. If you'd like to talk to me about your business, drop me a voicemail on moneyneversleeps.ie. Finally, till next time, thanks for listening. See ya!